Welcome back, sunshine. This is Kathleen Finester, your neighborhood realtor in South Florida. My topic today is about money. I'm sure you're ready to buy a house. You want to buy a house, but you're saying, I can't buy a house because I don't have the money. Well, there is no other money that is better than OP money, other people's money. And I'm going to show you how to get that and what type of money is provided to you in order to buy a house. Of course, our title today is 5 types of home mortgages. You need a mortgage. If you want to buy a house and you don't have money, you need to get other people's money, and that's through a mortgage. So stay tuned as I go through this video slide to discuss about the different types of home mortgages that you can receive. Thanks for watching. Okay, so you're ready to get financing. So today's topic is about the 5 different types of mortgages that you'll need to know about. I will go over what is a VA loan, FHA, conventional, and then the variations of the 3, fixed rate and adjustable rate for this segment. Alright, so you want to buy a house? Let's start with the VA loan. If you are a veteran, you need this loan. There should not be any veterans that is without a house. All veterans can buy a house. The government has set up a loan type that fits your circumstance, because as a veteran, you've done your due diligence, you've done service for your country, and you should opt for the best type of loan. And this loan is it. With the veterans loan, you will be able to receive 100% financing. That means if the house is worth $200,000, you're going to get $200,000 as a loan. You don't need to put a down payment, so no down payment needed. There's no private mortgage insurance, and there's no penalty for early payoff, and the loan is assumable by another vet. So if another vet decides to buy your house, they can assume your mortgage. Vice versa, if you go to buy a house that is owned by a veteran, you can assume their mortgage. So they might have purchased their home for $200,000, but now their mortgage is now $180,000. So you get to perhaps negotiate for the $180,000 and take over their loan. So that's a wonderful option, as well as the FICO score. Guess what? Your credit score doesn't have to be perfect. As a matter of fact, your credit score can be a 580 and you can still receive 100% financing. And even if your credit score is worse than 580 and you're in the 500s, you can still receive financing. It just will require you to put down at least 10% given that situation. But can you imagine? You can have a loan as a veteran. You can be in your own house. Definitely give me a call. The next type of loan that I want to discuss is the FHA loan. The FHA loan is a federal housing administration. It is backed by the government. It is guaranteed by the government. Therefore, their requirements are much more laxed. With the FHA loan, there's a down payment requirement as low as 3.5% of the purchase price. Your FICO score can be as low as 580 to receive a loan. The loan to value would probably be, give or take, between in the 60s or 80s. They don't often give 100% financing, but that can change. You do have to pay a mortgage insurance on your monthly payment. That is within your mortgage payment. So you really don't see it. It's just a small amount that you pay within the mortgage, called a mortgage insurance. So if for an FHA, you can, of course, find property to purchase. However, there are in South Florida, there are some limitations with having an FHA loan, especially if you want to buy a condo, because the condos don't often take FHA loans, and that has a lot to do with whether the condo association has reserves, has money in reserves. So often most condo associations do not. So this is a case-by-case basis with the new laws regarding the FHA loan. So FHA is a great loan because you can bring down less down payment, and you have a low credit score requirement, and it's guaranteed. So no problem with that. Fill out the application you basically, go through a mortgage broker and fill out your application for a mortgage, and then they will tell you, based upon your income and your credit score, whether you qualify for an FHA loan. The same goes with what is called the conventional loan. Now, this conventional loan is not backed by the government, is not insured, but if you have really good credit and income, a conventional loan is a good option. They require 650 credit score and up. They usually require 20% down. When you do put 20% down, you don't have to pay a PMI insurance. You don't have to pay private mortgage insurance. However, there are conventional loans that allow 3.5% down, but you will still have to pay the PMI insurance. In that case, you'll have to pay private mortgage insurance alongside your mortgage. So if you decide on the conventional, it allows you open door to different properties. So you can buy condos, you can buy homes, and you will not be restricted through the conventional mortgage, and that's mainly because also the credit score is in the average or really good FICO score. The variations to all of these mortgages, you probably will hear of the fixed rate mortgage. Now, the fixed rate mortgage is usually what an FHA conventional VA loan will offer. And basically what that means is that your payment, your monthly mortgage payment, is fixed for the remainder of the loan. So as long as you have the loan, you will be paying the exact amount, okay, as the price appreciates on your mortgage. So for example, if you bought to purchase a home and you have a mortgage for $2,000, you'll be paying that mortgage $2,000 every month. So it will be fixed for the period of the loan, 15, 30-year fixed rate mortgages. However, if you you do have the option of getting what is an ARM, an adjustable rate mortgage. Now, with any of these mortgages, i.e. FHA, conventional, the mortgage brokers have what is called an ARM. Now, an ARM, adjustable rate mortgage. The adjustable rate mortgage basically adjusts with the market. So the interest rate will either decrease or increase based upon the market at the time. And usually they have what is called a term rate. For example, it can be fixed for 2 to 5 years, and after the term will increase based upon the market. So that 2,000 will either go up 2,100 or go down 1,900. So that option is usually meant for investors. So if you are an investor and know that you're only going to keep the house for a certain amount of time, and you're going to sell it prior to the interest rate adjusting, then this is a great option. It's not necessarily a great option for a homeowner who's if this is going to be your primary residence. If this is going to be your primary residence, I do advise that you go for the fixed rate mortgage. So today you learned about the different types of mortgages and basically the money that you can get to purchase your own home. And if you're ready to purchase, what you need to do is identify the mortgage company. First, you would want to go to either your bank or a mortgage broker. Usually you can get a mortgage broker via your real estate agent. They also work with mortgage brokers that can assist you. So you want to go through the mortgage broker, apply for a mortgage, and after you've applied for the mortgage based upon your interest, based upon your FICO score and your loan to value ratio, how much you make and how much is coming out, they'll be able to tell you whether you qualify for an FHA loan or a conventional loan, and from there you can go on to purchasing your home. So good luck on the process of buying your house. I'm hoping all will go well, and if you choose me as your realtor, you will definitely see through going through that process as a fun experience.